Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hello and welcome to the Better System Trader podcast. Glad you could join us today for this episode number 159. And in this episode, we're discussing portfolios, specifically portfolio construction and optimization. Now, there is often a lot of focus on the actual trading strategies or the investments, and portfolio construction can sometimes become an afterthought or not even considered. But as we're going to hear today, portfolio construction and optimization can have a huge impact on increasing wealth. But there are a number of aspects that we need to consider. And joining us today as our special guest is Adam Butler, CIO from quantitative asset management company Resolve Asset Management. Adam has published some interesting research on portfolio construction and optimization, and he's even provided a portfolio optimization framework that can help to guide investors and traders toward the appropriate optimization methods. Now, we cover a lot of interesting points about portfolios in this discussion, so let's jump right into my chat with Adam Butler. Hi, Adam. Welcome to the show. It's really great to have you here today.
Andrew, thanks so much for having me. This is going to be fun.
Yeah, absolutely. So before we get started, how about we get to know you a little bit better? So can you just give us a little bit of background on yourself?
Sure. I'm the Chief Investment Officer for Resolve Asset Management, which is a quantitative asset management company based in Toronto. We started out several years ago running primarily global tactical asset allocation strategies with ETFs as the underlying. And over the past few years, we've been sort of nudged into deploying our approaches in global futures markets, driven somewhat by a desire to increase the breadth of instruments that we can trade and independent risk factors, and also tax considerations, liquidity, leverage options, those types of things, which futures are designed to accommodate.
Yeah. So before that though, what actually interested you in the markets? Like, how did you get started to where you are today?
Well, I got started by taking notice of an investment challenge in university, and I was on track to either go into clinical psychology or psychiatry. And I stumbled onto this investment challenge that was being promoted by a brand new discount broker. This is back in the mid to late 1990s. And there was a discount broker started by Toronto Dominion Bank here in Canada called Greenline. And so it was the Greenline Investment Challenge. And they provided contestants with about $500,000 in fictitious funds and access to real-time quotes on stocks and options in Canada and the US. And the objective was to turn that $500,000 into as much as you could over a 3-month period. So you can imagine that, there are certain techniques that are guaranteed not to win. In order to win, you've got to take lots of all, and you've got to have take a large number of highly levered bets, and in fact, that's exactly what I proceeded to do. I traded mostly in options and tech stocks, and happened to be on the right side of the market at that point, and ended up winning that challenge. And that gave me the illusion that this was an easy game. And then even worse, I went on to place very highly in the next investment challenge using similar techniques. So it was, I learned 2 very, very bad lessons right off the bat.
Yeah, sometimes having some success straight away or early success can actually be damaging over the long run. So that's interesting that you said that you learned some lessons from that straight away.
Oh, yeah. I actually think for markets that early success is the worst possible experience that a trader can have, because at least at least when you're trading early, you typically are trading with very, very small amounts of capital. I remember after my trading challenge, I recruited my housemates in university and convinced their parents to give me a few $1,000s. And then I remember handing them back about $600 of their few thousand that they'd given me a few months later. So I didn't have very much money to lose, right? It's when you have success early on and then you go on to parlay that into a very large trading account. And then you learn your hard lessons on the large pot of money that things become problematic.
Yeah. So I just want to jump now to one of the reasons why we're talking today is you've recently published some really interesting research into portfolio optimization, which I'd like to dig into a little bit. But firstly, why did you actually decide to focus on portfolio optimization? Like, what was it about portfolios that really caught your interest?
I think it was the realization several years ago that you sort of can't escape the portfolio construction process. Every portfolio inescapably expresses some unique set of views about, the nature of markets or relationships between risk and return. And, by habit or convention, most investors employ these rules of thumb for portfolio construction without really giving much thought to why those rules are used and whether they make any sense in the context of the specific investment universe under consideration. So I wanted to provide a coherent framework for investors to use to think about how best to construct portfolios. Listen, investors can either go into the portfolio construction process with eyes open or with eyes closed. And we wanted to provide a guide for those investors who wanted to go into the process with eyes open.
Yeah, so I think there's probably some misapprehensions and some challenges about portfolio construction. What are some of the common ones that you see traders and investors facing in your own experience?
Well, I think if you ask most investors when they're calm and thoughtful, they will say that their objective for investing is to maximize wealth. But in markets, you're maximizing wealth subject to wanting to minimize the amount of risk you've got to take to generate your wealth, right? So, when the objective is to maximize wealth subject to the minimum amount of risk, there's a name for that in academic finance. It's called mean variance utility. And so, let's begin with sort of the blanket assumption that most investors, when they're thoughtful, are mean variance optimizers. And so if we start from that premise, then we can identify some very common ways of forming portfolios that clearly don't map coherently to what we observe in terms of market behavior. And one of those is the CAPM, and which is ubiquitous and which is the sort of foundation for this passive investment movement towards market cap weighted portfolios. And if you dig into the details of CAPM and market cap weighted portfolios, you discover that in fact they are based on an incredibly flawed premise, and they're not likely to produce the maximum amount of return per unit of risk.
So I think this is probably a good opportunity to dig into this paper that you've published called The Portfolio Optimization Machine, a General Framework for Portfolio Choice. Firstly, do you want to explain a little bit about how this paper came about and what it talks about at a high level?
Sure. The objective was to provide a roadmap for investors to use, a very practical guide for investors to use to decide how best to construct their portfolios, given certain assumptions about what they know about the assets, or what they think they can estimate, rather, about the assets that they're investing in, and what they believe in terms of the nature of the relationships between risk and return between those assets. So, for example, what do we need to form mean variance optimal portfolios? Well, we need maybe an estimate of returns, an estimate of the relative risks between the different assets, and an estimate of the correlation relationships between them, the degree to which one investment zigs while another investment zags. And, depending on the level of sophistication, humility, technical proficiency, or belief system about markets, different investors may feel that they can reasonably be expected to estimate returns or correlations or volatilities, two of those, all three, just one. And so, we can sort of take beliefs about what we can estimate and couple those with beliefs about what we think the relationships between risk and return are in markets, and use those to select the appropriate portfolio construction method given that set of assumptions. And so there's a very clear roadmap that we go through to guide investors toward the appropriate optimization method. And that optimization method might be equal weighting. It might be market cap weighting, but it also might be methods such as true mean variance optimization or minimum variance or maximum diversification. It really just depends on, again, what do the investors believe they can reasonably estimate in a way, with a level of precision that's better than random, and then what do they believe about the relationship between risk and return for the assets in a portfolio.
Yeah. I think that's the kicker there, though, because in the paper, you've got a decision tree which helps you choose the right optimization. But as you mentioned, a couple of words that you just said there, assumptions, estimates, belief, reasonably, there's a big margin of error here, depending on how good you can estimate what your beliefs are. How do you kind of take that into account?
Well, we don't need to speculate. We've got research going all the way back to the early 90s, probably earlier, but a seminal paper by two academics, Chopra and Ziemba, in 1993 show that the estimates of covariances for, in other words, combinations of volatilities and correlations for the typical asset universes that most investors are dealing with are reasonably stable and they're reasonably good. So, we can actually generate reasonably reliable estimates for volatility and correlation, and errors in those estimates don't have a particularly large impact on portfolio outcomes. Right. Where the real challenge comes in is where we feel that we have real conviction in estimates of returns, because first of all, returns are notoriously challenging to estimate, especially over short or intermediate horizons, and I would argue over very long horizons as well. And the fact that they're hard to estimate is compounded by the fact that errors in estimates of means are 30 to 50 times more impactful to portfolio outcomes than errors in covariances. So if you're going to estimate means, you've got to apply techniques that buffer you against the impact of errors in those estimates. And one of the really interesting things I show in the portfolio optimization paper is that there are a variety of extremely coherent mean variance optimal ways to construct portfolios that don't require you at all to provide an estimate of means, but rather allow you to make some strong assumptions about the most likely relationships between risk and return between the assets. And so the ability to obviate the necessity to estimate means is very, very powerful, and it allows investors to take advantage of the potential diversification and risk management benefits from optimization without having to go down that error-prone and dangerous path of mean estimation.
Yeah, so you said 30 to 50 times impact. That's pretty huge. Does that imply then that perhaps in some cases it's better not to even try?
Well, absolutely. I mean, we are in the process of writing several articles on how you can use or incorporate estimates of means in portfolio optimization, but by using resampling, boosting, bagging, some of the techniques from machine learning, shrinkage methods, in order to reduce the potential for those errors to swamp whatever information you might be gathering from the signals that you're using to estimate means. But in general, there are lots of occasions where investors really don't need to provide active estimates for individual means of the investments under consideration. And I think individual stock portfolios are a really good case study for that.
Yeah. Well, you've actually done some case studies, I think, right? Because you've, it's one thing to provide a framework or a theory for which portfolio methods should work under different circumstances or different conditions, but you've actually put the framework to test on live data. Can you share a little bit about the studies that you've done and what you've learnt from that?
Absolutely. If you'll indulge me, I'll sort of back up a little bit and provide sort of theoretical basis and then talk about the tests that we did.
Sure.
Because it's important to have a theoretical basis for choosing the optimization that you end up choosing. And I'll go back to the idea of capitalization weighted portfolios. So capitalization weighted portfolios are mean variance optimal under the very strict condition that the expected return to stocks are a linear function of those stocks' beta to the market portfolio. And so if that doesn't hold, if that specific relationship between risk and return for stocks doesn't hold, then the capitalization weighted portfolio is not mean variance optimal, which means that you can easily form another portfolio that's likely to deliver higher returns for less risk. And so if you go back and examine the true relationship over history between risk and return in stocks, what we see is that there is no relationship between a stock's beta and its next period return, or a stock's volatility and its next period return. So if you've got a basket of very high volatility stocks and a basket of very low volatility stocks, the high volatility stocks and low volatility stocks have the same expected return. And what that means is that if all these stocks have the same expected return regardless of risk, then the only objective that we should have in forming a portfolio of stocks is to minimize the total risk of the portfolio. Yeah. Now you can do that in a few ways. You can simply allocate to just a smaller basket of very low volatility stocks, and that's the way that the sort of low volatility anomaly might be expressed, right? But alternatively, you can think about it as an optimization problem where you want to use diversification among all the stocks in order to minimize total portfolio volatility. And the optimization that expresses that objective is the minimum variance optimization. And so that sort of builds a theoretical case. And then, as you said, we actually put this to the test in live data. So we actually went and sourced a paper by De Miguel, Gerlapi, and Uppel from 2007, where they put a variety of optimizations to the test relative to an equal weight portfolio. And they concluded that equal weighting was just as compelling a way to form portfolios as using optimizations. And we go through why the theoretical basis for their paper may have been a little bit misguided. And then we proceed to perform the same tests that they tested. So, for example, we examined a 10 sector portfolios, the 10 industry sectors for the S&P, call it telecommunications, financials, staples, that sort of thing, right? So 10 sectors every month, form the minimum variance portfolio of those 10 sectors, do that every month through time using the past 12 months returns to form a covariance estimate, and then examine the performance of those continuously re-optimized portfolios relative to an equal weight portfolio. And what we observe is that the minimum variance portfolio completely dominates the portfolio, the equal weight portfolio, and it dominates other optimization techniques, which is what we would expect given the observed relationship between risk and return for stocks. And then we proceeded to do similar tests for other stock-oriented universes, like 25 portfolios formed on sorts by size and book to market from the Ken French database, a more granular industry portfolio, 39 industry portfolios, 49 industry portfolios, all of this data freely available from the Ken French website. And what we observe in every case is that the optimization that expresses the true historical relationship between risk and return among stocks, in other words, no relationship, continues to dominate. And of course, what I want to emphasize is that while the minimum variance optimization may be the right expression of that relationship between risk and return for a stock universe and deliver the best results for stocks, that may not be true for all investment universes. And we do discuss for example, the problem of asset allocation universe as well.
Yeah. Well, that was going to be my next question, actually, because you said the study was based on the observed relationship between risk and return in stocks. But what about perhaps futures? How does that then apply or change when looking at a futures portfolio?
Right. So the futures are really grouped between broad commodities and bond futures and equity futures and currency futures, right? So there's no expected long-term return from holding a basket of currencies. And in fact, it's almost incoherent to think about, what direction are you holding one versus the other, right? So if we sort of set currencies aside and say that we've got sort of broad commodities, broad diversified global bonds, broad diversified global stocks, well, what we observe historically is that markets are fairly risk efficient. Once you diversify away all of the idiosyncratic risk from individual securities, and so you isolate those systematic risk factors like the equity risk premium, the duration premium for bonds, the long-term carry premium for diversified commodity futures, then the markets are fairly risk efficient, by which I mean that markets produce approximately the same amount of return per unit of risk. So it's not that these broad risk premia, like broad commodities, broad bonds, and broad equity, all have equal returns regardless of risk. Rather, equities, for example, over the long term have about twice the volatility of a longer term bond portfolio, and over time, the equities have about twice the return, right? Which is what you'd expect if markets are risk efficient, and it's similar to commodities. And there is an optimization that very explicitly expresses the assumption of this sort of relationship between assets, the relationship where all assets have similar expected return per unit of risk. In other words, same expected Sharpe ratio. The optimization that's mean variance optimal under this assumption of the relationship between risk and return is a maximum diversification or risk parity type portfolio. And in fact, when we go back and we test the performance of different types of optimizations on asset classes going back to 1990, we do see that a maximum diversification and other risk parity type optimizations do deliver a very statistically significant boost to long-term Sharpe ratios, certainly relative to, for example, an equal weight portfolio, or relative to other optimizations that do not express the appropriate relationship between risk and return.
Yeah. I think you just said a little bit earlier, I may have misheard, but in your studies you were looking at rebalancing periodically. I think it was every month or every 3 months, something like that is what you said. Now, when you're looking at diversification and you're measuring things like correlation, obviously correlations shift over time. What have you noticed about, rebalancing or perhaps, reassessing portfolio construction periodically, how does that impact the results?
Well, we take a very extreme view on diversification. We feel that you should be maximizing diversification in terms of the investment universe. You should be maximizing diversification in terms of your rebalancing, and you should be maximizing your diversification in terms of the process that you use, so the signals that you use in order to construct portfolios. But just to sort of dig into the idea of rebalancing, the reality is if you want to rebalance on, for example, on a monthly basis, then it is more ideal to rebalance every day of the month, 1/20th of the portfolio, because you're diversifying away the risk that you just have bad timing luck. It could be that over a 3-year period, if you rebalance quarterly, then you're only rebalancing 12 times. Just purely by bad luck, it's very easy for you to just have a couple of those rebalancing days that are, where the markets are not in a favorable or constructive position for your rebalancing, and it'll hurt results. And so what you want to do is stagger those rebalancing days as often as either your capital allows or your operational infrastructure allows. But seizing the opportunity for diversification across not just the asset universe, but also rebalancing frequency. If you're trading trend models across different specifications of trend horizon, across different ways of measuring trend, is it risk-adjusted trend over 60 days? Is it distance above moving average? Is it just simple average returns? Is it regression slope? There's a almost infinite variety of different ways you can measure trends, breakout strategies, etc. Diversifying across all of these different methods is better than having to choose any individual one. And so you can just see all the different dimensions that it's possible to diversify your systems in. It's not just diversity across the asset class universe.
Yeah, that's an interesting point you make about the risk of rebalancing on specific dates and the role of luck there. And if I remember rightly, I think you just said rebalance 1/20th of your portfolio every day. So then you're spreading that risk or reducing that risk by diversifying the dates of rebalancing.
Yeah, well, that's for a monthly rebalance horizon, right? Rather than rebalancing consistently on the last day of the month, instead, rebalance 1/20th of portfolio every day of the month. If it's quarterly, maybe you want to rebalance a quarterly portfolio at the end of every month, where 1/3 of the portfolio trades at the end of January, another third trades at the end of February, another third trades at the end of March, right? And so you spread your quarterly rebalancing across 3 different monthly tranches, and that substantially diversifies the timing risk, right?
Yeah. So I'd like to dig into the why now. Why should optimization work? I think as humans, we love to understand how things work or why they should work. So what do you think are some of the fundamental reasons why optimization should produce superior results?
There's actually a mathematical axiom that comes out of information theory that Grinald and Kahn brought to light for finance, called the fundamental law of active management. And it states that the information ratio of a strategy, and for those traders who are not benchmark specific, the information ratio is just a Sharpe ratio. So let's just say Sharpe ratio or risk adjusted performance of a strategy is a function of the skill of the signals that are used to choose the securities that you want to hold at any given time, and the square root of the breadth of bets that you're taking in the portfolio. And you can increase breadth by trading more frequently, or by trading more independent signals or independent bets within the portfolio. And so what we show very directly is that portfolio optimization allows you to increase the number of uncorrelated bets. In other words, it does a better job of seeking diversification in the portfolio. And just as an example, we go through a universe of 47 or 48 futures markets, and we use a formula from Chiffoutet that allows us to mathematically quantify the number of uncorrelated bets in an investment portfolio as a function of the correlations between all of the assets and the weights of those assets in the portfolio. And what we find, just using the very long-term correlations between these 48 futures markets, is that an inverse volatility weighted portfolio of these futures markets produces about 6.5 uncorrelated bets on average, using the very long-term data. Now, some recent papers have suggested that in order to seek better diversification, an investor should use an equal risk contribution methodology to create the portfolio. That's one of the ways you can create risk parity. And what we find is that, again, using the very long-term covariances, the risk parity portfolio generates about 10 independent bets. Now, if you want to truly maximize the diversity in the portfolio, there's an optimization for that. It's called the maximum diversification optimization. And it's a mean variance type optimization. And when you use this optimization to create the portfolio weights to maximize diversity, you actually end up with 13 independent bets. And just to sort of bring that back to Grinold's fundamental law and its impact on the expected Sharpe ratio, if you've got 13 bets from one portfolio construction method versus 7 bets from a more basic portfolio construction method, then your expected boost to Sharpe ratio is the square root of 13 over 7. And that works out to a force multiplier on expected risk-adjusted performance of about 36%. Just to put a concrete number on that, let's assume your strategy at a 10% expected volatility is expected to produce a 10% excess return. In other words, it has a Sharpe of 1 using a basic portfolio construction method. Well, if you instead use a more optimal portfolio construction method, then at the same 10% volatility, you might be able to expect a 13 or 13.5% return. So you can see how that type of just more thoughtful portfolio construction can be a massive force multiplier for compounding wealth.
Yeah. So if portfolio optimization does have such a great potential to improve performance, why do you think people avoid it?
Well, because the straight out of the box portfolio optimization methods, if you're trying to use it for more complex universes, like, for example, the diversified futures universe or a large stock universe, there are well-known statistical challenges. For example, let's say you're trying to optimize 500 stocks and you've got monthly data, monthly returns. Well, in order to actually be able to create the mean variance optimal portfolio, you need 500 months of data for all of the stocks, or else you can't even run the optimization. It's incoherent because the covariance matrix is ill-conditioned. And so, there are ways that you can, there are techniques that you can adopt that massively attenuate the challenges, these sort of statistical challenges, and end up creating much more diverse, much more stable, robust portfolios using optimization than you would get from optimizations straight out of the box. So, the fact is, investors need to do a little bit of homework. They can't just use the optimization methods that they first learned about in their, basic numerical methods class or their CFA program. It takes some more digging to learn more robust optimization methods, but it is absolutely worth taking the time. Our own research suggests that the potential force multiplier from a very practical standpoint in live portfolio performance can make a massive difference to portfolio outcomes over the long term.
Yeah. So as you mentioned, portfolio construction can be complicated and there's a lot about it, lots of moving parts, lots of things to consider. And if you had to boil it down to the absolute essence, what do you think would be like the number one secret to portfolio construction?
Be humble. Use shrinkage methods. Don't place too much weight on your sample estimators. Use the very well documented methods in the literature for creating just more durable and stable estimates for covariances and means. But I mean, just the overarching message is that the objective in an uncertain world is to seek the maximum amount of diversification possible. And you just cannot achieve the total potential diversification for most portfolios without having a reasonably good grasp of optimization techniques.
So for people who wanted to learn more about portfolio optimization, now, if you don't mind, I'd like to publish some links on my website to the articles that you've published. But are there any other ways that you recommend people can dig deeper into portfolio construction and optimization?
Yeah, so I would Google papers by a guy named Marco Lopez de Prado, who has some very interesting papers on portfolio optimization, and also some papers by Richard Michaud, Michaud, who pioneered work in multivariate resampling and the resampled efficient frontier. And if you get through some of the more popular papers by those authors, you will be very well prepared to do some of your own digging and your own research on robust portfolio optimization methods.
Yeah, okay. Well, thanks for those recommendations, Adam. Now, I'd just like to start wrapping up now with some quick closing questions.
Shoot.
So the first one, what's the biggest lesson you've learned through the markets?
Yeah, so I'm just going to repeat, stay humble.
Yeah.
The results that you generate from backtests are subject to an enormous amount of noise. And let me give you an example. So in our adaptive asset allocation strategies, we run 41 different ways of measuring trend and then transforming those measures of trend, and optimizing the portfolios based on trend. And what's interesting is that you can run a simulation on our diversified multi-asset universe for each of these 41 methods, all the way back to 1990 using daily data. And we generate Sharpe ratios between 0.9 and 1.65, okay, for these 41 different methods. And so what we know is that the standard error of the Sharpe ratio for strategies with a Sharpe ratio on the order of about 1.25 and over a 30-year horizon is about 0.3, 0.35, which means that the 95% confidence interval is somewhere between about 0.75 and 2.1. And so what we know statistically is that 0.9 Sharpe ratio simulation that we ran and that 1.65 Sharpe ratio simulation, we cannot reject the null hypothesis that they actually have the same true underlying Sharpe ratio. So we just use all of them. And in fact, the most incredible thing about this is that you've got this diverse group of strategies with such a wide range of individual Sharpe ratios. But when you just combine them all in equal weight, the Sharpe ratio of the equal weight across all of the different Sharpe ratios, that Sharpe ratio is above the 80th percentile of all the Sharpe ratios in the across all of the 41 sub-strategies, which just goes to show the power of diversification, not just in terms of how you construct the portfolio, but also in terms of the diversification of process.
Yeah, that's very interesting. Thanks for sharing that, Adam. Next question. Do you have any favorite trading books?
I don't know about trading books, but the book that I would recommend to anybody, any investor of any level, absolutely my favorite investing book of all time is called Behavioral Investing by James Montier. I think it was written in 2006 or 2007, maybe even earlier than that. The first half of the book goes through the psychological research on cognitive biases and all of the different ways that our mind plays tricks on us, and all the different ways that humans, our wetware is just not well designed to participate in a market environment. The heuristics that we evolved to have as humans from our time living on the African safari are just not well calibrated to the behaviors that are likely to lead to long-term profitability in markets. And this is true for a wide variety of reasons. And he goes through all of these different biases in great detail. And it's just unbelievably illuminating. And then the second half of the book describes the literature. It's sort of an older survey of literature, but I still think extremely relevant, of all of the different systematic methods that have been shown to be useful for security selection across a wide variety of investment universes. And so just that literature review itself is also extremely illustrative. So cannot recommend that book highly enough.
Okay, cool. And if listeners wanted to either get in touch with you or learn more from you, how can they do that?
Yeah, I just go to investresolve.com. We've been publishing blog articles. It's just like a research diary since 2009. And we've got over 200 articles on there now with a variety of levels of technical sophistication, spanning financial planning to behavioral biases through to faster computational methods for portfolio optimization. So we really do run the gamut. We recommend viewers or listeners check that out for sure.
Yeah, absolutely. I mean, we've only just scratched the surface of the information that you have and the knowledge. So I recommend people go over and check out the website Invest Resolve and have a look at those papers on portfolio optimization too. Very interesting. So thanks for that, Adam. So is there anything else that you'd like to mention before we wrap this up?
No, I think we covered a lot of ground today, Andrew. Thanks for the thoughtful questions, and maybe this leaves us with an opportunity to do this again sometime.
Absolutely. Well, thanks for spending time with us today, Adam, and sharing just some of your insights into portfolio construction. It was really great chatting to you too, so thanks again, and I wish you all the best.
You too, Andrew. Thank you.
Right, cheers. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.